Today, the Monetary Policy Committee agreed to raise the official cash rate to 0.75%. We agreed it remains appropriate to continue to reduce the level of monetary stimulus so as to best maintain price stability and support maximum sustainable employment. The level of global economic activity continues to rise, supported by accommodative monetary policy and fiscal policy settings and the relaxation of the COVID-19 health restrictions. The pace of the global economic growth has ebbed, however, due in large part to the elevated uncertainty of the virus health risks. Global supply chain disruptions are causing both cost pressures and constraints on production internationally, and this is occurring at a time when consumer demand remains very strong. So central banks globally face the challenge of distinguishing between transitory price changes and more generalised inflation pressures as they decide on the appropriate stance for their monetary policies. At home, here in New Zealand, our public health restrictions are easing as the country transitions into the COVID-19 protection framework. The framework will enable greater mobility of people, goods and services throughout the country. With the easing of the restrictions, however, it is anticipated that the COVID virus will become more widespread geographically, but it will be manageable for the health authorities and less harmful for those vaccinated. However, households and spending investment will be dampened in the near term by this continued health uncertainty. The recent nationwide health lockdowns, the more prolonged restrictions in Auckland, Northland and the Waikato, and the continued level 2 restrictions elsewhere resulted in a sharp contraction in economic activity over recent months. But despite these lockdowns, the underlying economic strength remains in the economy, supported by aggregate household and business balance sheet strength, as well as fiscal policy support and continued strong export returns. As a result, capacity pressures have continued to tighten. For example, employment is now above its maximum sustainable level. A broad range of economic indicators highlight that across New Zealand, the economy continues to operate above its potential level. Headline CPI inflation is expected to measure above 5% in the very near term before returning towards our 2% midpoint target range over the next 2 years. The near-term rise in inflation has been accentuated by higher oil prices, rising transport costs, and the impacts of the global supply shortfalls. These immediate relative price shocks risk generating more generalised price inflation, especially given the current domestic capacity constraints. In summary, the committee noted that further removal of monetary policy stimulus is expected over time, given the medium-term outlook for inflation and employment. Kia ora, thank you for listening. We are open for questions.
First question is from Praveen Menon from Reuters.
Thank you. Good day, Governor. My question is about the government just announcing some easing of border restrictions starting from January and all the way up to April, May. Does that change the outlook in any way, or do you think perhaps a more aggressive tightening would have been more appropriate given the next opportunity is only in Feb?
Thank you for the question, and very timely as well. This announcement you mentioned was less than 2 hours ago. The answer is it does not change our outlook. We have anticipated throughout an increasingly more liberal movement of goods, services and people, both domestically and internationally, and the steps we see the government has taken are consistent with that framework.
Next question from Ainsley Thompson from Bloomberg.
Mic on. You're on mute.
You're on mute there. Sorry, Ainsley. We'll come back to you. Madison Reedy from News Hub.
Kia ora, thanks so much for this today. Look, first off, can you tell me if the committee considered a 50 basis point increase or larger?
Yes, thank you. We did consider a range of options. It's what I would consider good practice So 50 was amongst it. What you see today is our best foot forward around with the balance of risks as we see it. Slow, steady changes in the official cash rate give us more optionality to observe how the economy is behaving and balancing the risks that are in front of us. We have upside risks given the near-term inflation pressures, given the capacity constraints that are there, and likewise on the other side we have the continued health issues globally and here domestically, and also we're very aware that monetary conditions across the board have tightened. Likewise, we have to be very careful. There is a considerable amount of debt and interest rate sensitivity. So, we're in a good space to observe and take our time at this point.
And just to follow up on that, if that's all right, are you also hearing the cries from hopeful first home buyers whose home ownership dreams are being crushed by the Reserve Bank's latest moves?
Oh yes, we live in the same economy as you do, and we're citizens of Aotearoa, New Zealand. Many of us have families, and we see this demographic challenge going on. We've been discussing the unsustainable level of house prices for quite some time now. We reiterate that again in this document, and our core view is that house prices will ease over the projection period, in part because supply is growing rapidly. It's becoming harder for investors given the various tax changes and regulatory changes, and likewise we're lifting interest rates. Meanwhile, we have our macro-prudential tools, our loan-to-value ratios in action.
Sorry, another follow-up on that. I'll make it the last one on this topic. We've obviously seen some major banks, ANZ the latest yesterday, now no longer accepting pre-approval mortgage applications from anyone with a less than 20% deposit. Were you expecting major banks to hit that 10% LVR limit so soon?
We've always operated on the fact that what we have said we're doing, we'd expect people to start moving in that direction, our regulated institutions. And so we discussed the move to the title loan-to-value ratio restrictions, and the banks have done that. I won't comment on any particular bank. We have to remember that it's all mortgage holders who will be experiencing higher interest rates. We are talking about managing tail risk where people are taking on excess debt into an asset price market, the housing market, that we believe is unsustainable in prices.
So just to follow up on that one, basically you're saying too bad, too late if you've already missed out, it's too hot, we've got to do what we've got to do.
No, those were your words.
Next question will go to try Ainsley Thompson again and then Sophia.
Hello, can you hear me this time?
Thanks, Ainsley.
Yes, great. You mentioned reaching maximum sustainable employment. I'm wondering, are you concerned about rising wages and that embedding into higher inflation?
Thank you. No, we're not worrying about that. We believe wage inflation has been very, I would say, well behaved, i.e. operating consistent with a very tight labour market, strong demand for labour, and we would anticipate and expect to see nominal wages grow as they have. We note that even though nominal wages have risen, they are still behind the CPI inflation rate of recent. But it's something, with a watching brief. I might pass, Jung, have I answered all of that?
That's right, correct, yeah. The movement in wage growth is consistent with tight labour markets, more acute in particular industries where skill shortages are particularly sharp. But yeah, generally wages are lifting in line with a tight labour market.
Cool. Next question from Sophia Rodriguez from Central Banking Intel.
Yeah, hi there. Your risk appetite statement, which is very interesting one that I noticed today, says that you have very low appetite for policies or decisions that could affect inflation expectations to become unanchored. How did you meet that low threshold, given that 5-year inflation expectations have gone up, and in the next 3 months, those could get unanchored?
Yeah, wonderful question, and thank you also for noticing our chapter on the risk appetite statement. We think it's very important that we know the bounds of risk we are prepared to take to succeed, and we don't want to take undue risk, operational, legal, reputation, financial. You've mentioned the inflation expectations one, and I think the simplest way of saying how have we met it is that we have reacted to rising inflation expectations by lifting the interest rate. I'd say we would have not met it if we had just sat there and observed it and done nothing about it.
Next question from Janae Tibshanae at Interest.
Hello. I note in the statement the Reserve Bank recognises how retail banks have lifted rates ahead of the decision today, I guess, because of these inflationary pressures. I'm just wondering what the bank's view is as to how much more it thinks banks will lift those retail rates ahead of the next OCR review.
Wonderful, thank you. I'm going to pass over to Christian to chat about that.
Yeah, so we've observed that mortgage rates have moved a long way. That's occurred really since July, where markets have increasingly priced in the prospect of us increasing the OCR in response to the tighter capacity pressures and inflation pressures building. So that's the market, pricing in some of the actions that we've already seen and are signalling now. We think that mortgage interest rates have moved broadly in line with the funding costs of banks. So there's both the wholesale funding costs and the retail funding costs as well. So we think we're seeing things play out largely as expected. Whether mortgage rates rise from here is really going to be about whether market expectations change in terms of our next steps. There's already a number of interest rate increases already priced into the yield curve as we stand.
Okay, and just to follow up, you also note in the statement the, interest rate sensitivity. So the fact that a lot of people's mortgages are on shorter terms, so they're coming up for renewal, but they really feel that the bite of the interest rate hike as they've felt the loosening as well. How much weight are you giving to this interest rate sensitivity factor as you're weighing up monetary policy decisions?
Yeah, a great question, and one of the reasons why we are comfortable taking the cautious steps with the official cash rate. Jeff, do you want to talk about the magnitude and price?
Yes, well, we've got about 70% of mortgages that we expect to reprice over the coming year, so effectively facing some of those higher mortgage rates that Christian has spoken about. I think this is really a question of uncertainty of exactly how people will respond to that as they see that coming through. We're not sitting here alarmed about it. We're just conscious that will bite into free cash flow, people's surplus that they have, and the extent to which that means that they hold back a little bit on spending or whatever is to be seen. So we have this picture of overall quite a lot of momentum in the economy and capacity constraints, but at the same time some headwinds, if you like, that play out in the year ahead, and we'll observe and watch that as the Governor indicated.
Bernard Hickey, the Kaka. It seems we have him on mute. We'll try Matthew.
Good afternoon, Governor.
Oh, sorry, go.
Thank you very much. I wanted to ask about the link between prices and wages, and whether you are seeing any signs, or you think there will be a risk of a wage price spiral, because in the last decade or so, wages have been pretty moderate, and something would have to change really to see a wage price spiral.
Yeah. So, thank you for the question. I can talk as a personal monetary policy committee member, but the discussion as a whole at the MPC is we are very comfortable with what we've observed with regard to wage setting behaviour. You would hope that if a particular good or service becomes very rare, then the price of that will rise, and that is the case for people. And so labour is the most sought after resource globally at present, and you've seen nominal wages rise. They aren't rising to any particular extreme level. They're still well below very recent peaks in terms of nominal wages. They've been operating in aggregate in a very well-behaved manner, and as I mentioned, behind the CPI inflation. And so real wages are still flat, if not declining. Having said that, there is a broad dispersion across wages. Some people are in positions where they can apply competitive tension on their wages. Not all labour forces are the same. So it's a very different dynamic in the labour force globally and here in Aotearoa, New Zealand, compared to, say, 20 years ago, as you mentioned.
Matthew Brockett from Bloomberg.
Yes, hello. Just wanted to ask a question about a comment at the bottom of the record of meeting where you speak about moving in considered steps with the OCR. Just want to get clarity on that. Is that to say that you expect to move in 25 basis point moves throughout this tightening cycle? And what might, how entrenched is that view? What might it take you to reconsider that?
Yeah, thank you, Matthew, and a very good question. I think the important part at the end of that also were two words: for now, full stop. And the for now part in the record of the meeting really just signifies the fact that this is a repeat game. We're back, every 6 weeks or so, and we will be refreshing our view of the outlook based on that information. And at the moment, with everything we have in our hands, we see steady steps of 25 basis points back to some level of interest rates, official cash rate that is marginally above a neutral rate as the most balanced approach we can take. If information changes, then of course we will do the action. That might be hold for a period, it might be taking larger steps. But for those ones, we need to see the information.
Next question, Janae, from Interest.
Yeah, thank you. This is just on the LSAT. Is the bank open to selling bonds ahead of them maturing?
Yeah, thank you. Christian?
Yeah, so we've indicated in the statement that we're planning to come back early next year with an operational strategy that really sort of sets out the future of the LSAT program. Our plan is to gradually manage down our LSAT holdings, and that plan will outline, how we go about doing that.
Just to follow up on that, in terms of in terms of removing stimulus. Obviously, there are a few ways of doing that, and the bank has signalled its preference to use the OCR to do that. I'm just wondering if you could explain what impact selling the bonds ahead of them maturing, how that might flow through and impact the economy in terms of, being a way of removing stimulus.
Yeah, thank you, and really good questions. As international banks, central banks internationally have, there's a combination of both the interest rate tool and the quantitative tools they have been using. Here in New Zealand, we made a big splash into the bond market deliberately at the outset of this COVID policy, and that big splash was deliberately aimed to get interest rates down, in addition to what we were doing with the official cash rate. Through time, the impact of our bond holdings has lessened. It has lessened through time, and so the marginal impact of us holding these bonds is now considerably smaller relative to the impact we're after and achieved on entry. Through time, whenever we set the official cash rate from now, we will always do it cognizant of the stimulus or tightening that is implicit in our bond holding positions. So in that sense, the interest rate is set conditional on all of the data, including our bond holdings. Over time, an important part of our strategy of managing down our bond holdings will be around what are we trying to achieve with regard to the effectiveness of monetary policy. are we able to manage down without creating any unnecessary uncertainty around our purposes and volatility in that bond market? And so we'll bring those principles back, but it's important to know that it's the official cash rate that we will change, and that will always be set implicit on all of the other actions that are happening.
Just one more thing. Is the official cash rate the preferred tool, because we know a bit more about how that works, and we've got lots of evidence historically to look at?
Absolutely. I mean, the quantitative easing is highly effective, particularly at times when you are near zero bounds on interest rates. We're still not far from a zero bound on interest rates, so they remain a very useful tool. We'll keep that in the toolkit, but the official cash rate, we have a much better handle on the feed-through impacts it has onto setting interest rates and then overall economic activity and inflation. It is a much well-beaten path, easy to talk about, easy to explain, but the quantitative easing are useful additional tools.
Next question, Tom Polistrica from Stuff, and then Lydia.
Yeah, good afternoon, Governor. The Reserve Bank has been sort of quite far out in its forecasts this year on both GDP growth, unemployment and inflation. Does that concern you?
No. It shows the very, very uncertain environment that all policymakers across almost any policy I can think of are confronting at this point. The fact that we are still managing to achieve our roll through time, to have markets in an orderly position and to have inflation expectations well anchored, over the period that matters for us, we're very pleased. We have always, and will continue to say, we provide projections to paint a broad story around why we are setting monetary conditions where they are. We never say that this is the most guaranteed thing that happens. It's just it's a storytelling option that can be done. Starting point surprises have been significant because, unfortunately, no one forecasts the Delta timing or arrival here in Aotearoa, New Zealand. There are so many factors that can impact through time. From here going forward, major uncertainty remains. We're very positive around the opening and more movement of labour and goods and services around the economy. But likewise, we're going to have to assess how that transition into the new COVID framework unfolds and how people behave. So major uncertainties. We don't put all of our eggs in one basket. I'm very proud of what we've achieved.
Next question, Lydia Lewis from News Hub.
Tamaria, can you hear me?
Yes.
So certainty, that's the word that people are clinging on to at the moment, especially homeowners and business owners. Can you signal from the information you have right now, how high could these basis points rise over the next 2 years?
Yes, we can. That's our forward projection at the moment based on everything we have and subject to no future shocks, which of course will never happen. We see the official cash rate being around 2.5% by the end of our forecast period, which is the end of 2023. You add a small but highly competitive margin on top of that and you'll get a bank lending rate.
Okay, next question from Brian Fellow, NZ Herald.
Can you hear me?
Yeah, go Brian.
Governor, I wonder if you could talk us through how you think about the impacts of monetary policy on asset price inflation and the wealth effect. How important has that been in the easing so far? How concerned are you about what happens if that effect is turned off or even goes negative going forward?
Yeah, thank you. I mean, part of what you're asking there is really coming back to, I think it was Janae's question around how how sensitive are asset prices to interest rate changes at the moment, and in particular household behaviour, given that's the assets. So that's something we will have to observe and learn through time. I will state, though, that the Reserve Bank, A, is not the only policy shop in town, and B, has more than just one trick, being monetary policy. We also have a financial stability set of goals and instruments, and so we work in tandem across both monetary policy and financial stability, and I'm very proud to say that the financial stability, the institutions, the balance sheets sides are in good stead, but not without risk. We have been saying very loudly that asset prices, house prices, are unsustainable. Meanwhile, across the broader wealth and wealth distribution issues, we have fiscal policy doing considerable work around supporting New Zealanders, as well as our interest rate work, not only assisting on asset prices, but also keeping people in jobs and employed. So, it's a complex thing. Do lower interest rates increase uncertainty? Do increase inequality? Do higher interest rates increase inequality? The answer is it depends, and the jury is out. But without doubt, those who have houses have done extremely well. Those who haven't had houses have maintained their employment, their wage growth, etc., but those asset prices have got away on them for now.
Stephen Wright, Wall Street Journal, then we'll go to Madison Reedy.
Hi, RBNZ team. So the bank is losing a couple of key personnel in the not too distant future at a time when it faces some quite big challenges in terms of withdrawing stimulus in a time of high economic uncertainty. So I wanted to know, is the bank mainly looking within its own ranks, or is it looking externally to replenish its key personnel? And are you also committed to being at the helm of the bank during the entirety of this unusual period?
I can answer but for myself, I have a continued term, but I can't tell you when this period of uncertainty finishes, so I'm not sure how to fully answer that question. For our global search for capability expertise, I could say that it is well advanced. We are an attractive place to work. If that was your job application, it's been received, and I do just want to take this moment just to note that who you're talking about. You're talking about Deputy Governor Jeffrey Baskand, who this is his last monetary policy committee that he can enjoy. But Yung Ha, as our chief economist, doesn't get away from us just yet. He's here through the February monetary policy statement. But in terms of capability, capacity, we are spoilt for riches. Thank you.
Next question, Madison Reedy, News Hub.
Lovely, thanks. To come back to inflation, and to use your words, Governor, the jury is still out on whether or not it is transitory or not. How worried are you about the current inflation and possibly higher inflation in this country overstaying its welcome? And if it does, how much harder does that make it to kick to the curb when you eventually can?
Yeah, thank you, and great question. You're looking at a group here who are paid to be worried about inflation getting out of control, and we are determined to make sure that does not happen. You will see higher CPI inflation over the near term because effectively that's already in the tin. These are the supply shock price pressures that you've seen. We read about them every day. We experience them when we try and order something or buy something directly from a shop, or we try to employ someone. So those relative prices are already here, and they are because of this COVID shock and the supply constraints that it has generated. What we want to make sure is that one-off relative prices don't become permanent generalised inflation, and this is why we are reducing the monetary stimulus, and we will continue to do so until we are comfortable that inflation expectations and inflation are well contained in our mandate.
In fact, just to follow on that, sorry, Oliver, as a matter of record, Governor, do you believe it is transitory or not?
No, we believe it's a combination of all of the above. So the permanent components you can see in our very rich monetary policy statement that I encourage all folks to read. It's got some beautiful photos in there as well. Fortunately, not of the Monetary Policy Committee, but in there we talk very much about the underlying generalised inflation, and then this froth on top being this tradable relative price inflation. And you can see at the moment it's about a 50-50. You know, half of the CPI inflation is around tradable CPI, another half is around domestically generated because of demand running ahead of supply. It's the latter that we really have most influence over. We can't influence global oil prices or other relative prices.
Next question, Janae Tibshane, and then we'll go to Sophia.
Thank you. Governor, how worried are you that the Reserve Bank's inflation forecast has increased since the last monetary policy statement, but the GDP growth hasn't changed too much?
Yes, so what you're seeing there is primarily a shock to the ability to produce goods and services in New Zealand because of the lockdown activity of recent periods, from level 4 whole nation to the other the challenges that the North Island have had. So that really is, you know, a here and now. It's not about the future. The future, we see the potential growth rate to be broadly as it always has been, if not a bit constrained in the short term because of the continued supply shortages. But we remain very confident about the potential, you know, the ongoing potential growth rate of this economy.
Next question, Sophia Rodriguez, Central Banking Intel.
Yeah, hi. I noticed that you are not talking about your mandate in your OCR decision statement. So where do you think you currently stand with respect to your mandate, given that inflation is going to be within the target midpoint, it will take another 3 years. So does it mean that you are not meeting your mandate for another 3 years?
We are inside our mandate. I think you're reading it in a very narrow snapshot measure. It's important to read the whole mandate and to understand the whole mandate. If we tried to raise interest rates now to head off a one-off price spike, we would dive the economy into a recession and would look quite stupid. So it's about focusing over the medium term based on what we know about the economy. We also need to move interest rates with a view to achieve our mandate, with a view to not creating unnecessary instability in output, interest rates and the exchange rate. And so that makes a far richer picture about whether we are in our mandate, which we know we are, than that snapshot version that you provided.
Can I ask a follow-up question, please? Can I?
Go ahead, Sophia.
Yeah. Well done on being the first central bank to make a connection between climate change and inflation, and which also includes near-term inflation. What message do you have for the other central banks who are not taking, who still see inflation as transitory and possibly not taking into account the impact of climate change on inflation near term and the medium term?
Wonderful question, and thank you for that endorsement. Again, the climate change challenges matter across all of our mandates here at the Reserve Bank: financial stability, the stewardship of cash, and of course, monetary policy. I would say we are learning along with and all other central banks. The network for the greening of the financial system is a network of over 100 central banks and other prudential regulators, and I would be wrong to claim we're on the frontier of any of this. We are actually amongst the pack, and we need to talk about it. Most of the talk is about financial stability and the challenges and opportunities for the financial institutions we regulate. But we also have to signal to the broader market that relative prices can be very noisy as we go through increased climate change volatility, but also transition into new forms of energy, new ways of doing business. And of course, there are policy shocks that come about. So again, it's going to be the variability of relative prices can get wider. We need to be able to look through that, stay calm and meet our mandate.
Bernard Hickey, the Kaka.
Governor, I wondered if you could talk a bit more about the wealth effect and how much of a restraint it is on the Reserve Bank doing what it needed to. In particular, if house prices are unsustainable, in theory, you could make them more sustainable by putting up interest rates. But the wealth effect of that could hurt the economy. So how much of a bind, if you like, are you in because of the wealth effect of the housing market?
We're not in a bind at all. I would disagree with your analogy. I mean, the first part is we're raising interest rates so that demand slows. If it slows through people feeling perceived less wealthy, then that is one means by which we slow demand. If it slows because of the cash flow challenges of higher than otherwise interest rates, then that's another way. They are both consistent with the path that we are trying to forge around reducing the monetary policy stimulus. Can I also, I suppose, disembowel the thought that we are worried about the wealth effect? What we are saying is that people have a lot of debt. What they've got that debt in is their choice, it's not ours. We're saying that they will be more sensitive than otherwise to changes in interest rates the more debt you have. And households who have a lot of debt or homeowners who have just entered the market with extremely high leverage levels have to be incredibly wary and understand they're going to have to be able to weather through higher interest rates. We have talked about this forever. Yet we still get complaints, I can't buy my first house without a zero deposit. So you have to be able to put the whole thing together.
And just separately, the Reserve Bank of Australia has announced an inquiry into the use of unconventional monetary policy over the last few years. Is that something that the Reserve Bank thinks might be necessary or is thinking about?
I'm not sure of the inquiry you're talking about, the reviewing. Christian?
Yeah, Bernard, we're not familiar with the inquiry that you're referring to. We're continually, looking at what foreign central banks are doing, their actions, looking at our own actions, and so we're, continually looking to learn and improve. And I think the operational strategy that we'll be outlining earlier in the year is part of that journey and the full transparency that we look to provide along the way.
I will note also, Bernard, that under our monetary policy remit, we are also required, actually in our legislation, we're also required to, on a 5-yearly basis, review the overall monetary policy framework. So I think we're a couple of years out from that, and we are starting our run-up because we want to do it properly and let everyone have a say in their views. So that's a broader mandate. That should not be news. That's in our legislation.
Madison Reedy in News Hub.
Governor, going back to the point on Bernard's question there on debt, you said that you were concerned about people's level of debt, but a lot of that debt, particularly mortgage debt, was taken on by people last year when the LVRs were taken off completely. We know that you operate with this least regrets approach, but is there any equal level of regret among the Reserve Bank about what you did last year, which is now having to be effectively fixed this year?
Can I note that it's banks that make the lending and banks that should be assessing whether an individual who is borrowing can manage debt levels under a variety of interest rate challenges. Banks were testing, we know, for interest rates not where they currently were but where they could be, 3+% above standard mortgage rates. So that stress testing has all been there. I would also like to point out, whilst there's a lot of excitement about the asset price growth over the last couple of years, the vast bulk of household debt, new debt's been coming in the last couple of years, but debt has got a long history, and household debt in New Zealand has a long history of being high and being highly correlated to house purchases. So it's not a new phenomenon, but it is at a high level at present, and that's why we've been providing these warnings, having the conversations with the banks and putting these loan-to-value ratios back in. I have no regrets of anything we did last year because in the uncertainty that all people faced, remember this was a period when the virus was brand new, vaccines hadn't even been invented, no one really knew what was going on. I did not want to be providing stimulus with one hand and then tripping over our own policy with the other. So we have acted consistently. To the extent that people have chosen to go off and do what they do, they need to interview themselves and have an interview with their bank.
Final question for Stephen Wright.
Okay, sorry about that. Can you hear me?
Yes, Stephen, go ahead.
Okay, thank you. You know, Governor, it's great to say that you've been giving people warnings, but I mean, I think the reality is that individuals respond to the incentives that they are provided with. Wouldn't it, I think, be a more constructive approach from the bank to acknowledge that and also to acknowledge its part in the housing crisis that is unfolding in New Zealand now?
Stephen, this isn't your first interview term here, and at every interview we have acknowledged that to your questions. Thank you.
Time for one final one then from Janae at Interest.
I guess it's a kind of like an existential question, but Governor, you've outlined the difficulty that the bank faced last year in terms of we had a virus, we didn't have a vaccine. The bank loosened policy substantially like other central banks did around the world. And anyway, now we've seen what that does do to asset price inflation, which is, pretty catastrophic actually for a lot of people, even though it's great for the 60% of people who do own houses. I'm just wondering, what the place is for the type of monetary policy that we use, looking ahead to the next crisis. The effects of using these types of levers are now are fairly well known.
Wow, I don't know where to start with all the assertions you put. Fairly catastrophic. I'm not sure that is the case. Unemployment, maximum sustainable employment at a almost record level, at least over the last 10 years. Full employment. The number one challenge is excess demand, not excess supply. I really don't know. I just don't buy into your proposition that has been catastrophic. Yes, it may be a challenge for those who feel they want to buy a house right now. Full stop. No, it doesn't mean that wealth inequality has magically increased. Those middle income people who had a house have enjoyed in that wealth. Those people who don't have a house have enjoyed in jobs. So it is a much richer conversation than just continuously focusing on the marginal home buyer. And I think our own research, our continued research program, and I would say Treasury as recently, have an enormous amount of material on that, and I encourage people to read it. In terms of our instruments and our policy, it's what you see today. We will continue to focus on low and stable consumer price inflation using the official cash rate.
That's come to the end of the questions. I'll let you wrap up, Governor.
Thank you. Well, I just want to just do one final thing, which is, again, make sure the camera shifts across to Deputy Governor Jeffrey Bascan. Thank you, good sir, for incredible, wise counsel on behalf of all New Zealanders, current and future. Kia ora.